Tom, welcome to the show, all the way from Pennsylvania today, huh?
Yeah, Brett. Yep, I am outside the city of brotherly love, outside Philadelphia, Pennsylvania. It's great to be with you today.
I want you to kind of steer us in your direction because you have almost 30 years of experience in the real estate world, in capital raising, in finance, even in some debt purchasing type stuff, and mergers and acquisitions. Man, it's just there. So first of all, tell us a little bit about Tom.
Sure. Yeah. Well, when you say 30 years, I'm like, who are you talking about? It couldn't possibly be that long. I guess the calendar doesn't lie. I got out of business school in 1995. So I guess I'm at 29 years out of business school. In fact, I'm the chairman for my 30th reunion coming up next year. So already, working. Speaking of raising capital, reaching out to my classmates trying to raise money for that. But yeah, man, it's gone by really fast. But I did have a nice stint in corporate world. I was doing mergers and acquisitions in the aerospace industry, which was a total blast. I was surrounded by some amazing people. I sat next to Neil Armstrong for lunch.
Oh, wow.
He was on our board of directors. Sally Ride was on the other side of the table. She was the first woman in space. And then ex-fighter pilots. My one boss was a Gold Glove boxer at the Naval Academy. Did his tour in the Marines and then went back to the Wharton School of Business for his MBA. So this is sort of the caliber of people that I really cut my teeth on when I started doing deals, back in the late 90s. And so I just loved that, and that sort of carried through my entire career. So fast forward to today, that business is known as U.S. Mortgage Resolution, and we've generated about $59 million of revenue in that business over that time period.
Wow.
We've transacted on, 12, 13,000 loans at this point. Anyway, so we've built a nice little business there, and it allowed us to do some other things. So we did some hard money lending. We were partners in a title company for a little bit, and then about 5 years ago, we found self-storage. So we said, hey, this is checking a lot of boxes. It's tax advantages. Capital preservation, income growth. It's an evolving industry. It's highly fragmented. There are a lot of things that we really liked about it. So we decided to build a team and go take a run at the self-storage business. So now we've acquired 18 facilities, about $50 million of acquisition value, 4,000 something units across about 7 states. I just feel very strongly that investors out there, especially investors who have reached a certain level of net worth, we call them accredited investors, right? So when you reach that certain level, you need to start thinking about things other than stocks, bonds, and mutual funds, and just stuffing your 401k with as much as you can. You need to start diversifying into truly what I think of as truly diversified assets, which would include, a self-storage facility in North Carolina or a mobile home park in Tennessee. If you can become a part owner through your investment process of those different kinds of assets, now you're really diversifying your risk. Your financial advisor will tell you that, diversification means, small cap, mid cap, large cap, or value and growth, or blended. When the stock market crashes, and I've lived through several stock market crashes at this point, they all have a correlation of 1. They all go down. It doesn't matter, right? So that is not diversification. Diversification is when you're starting to invest in these other asset classes outside of the public markets. These are private offerings, and they're out there all over the place. First, you have to have your goals, right? You need to know, what am I trying to accomplish with my investment portfolio, right? Most people are looking to either generate income, generate growth, generate or capital preservation, right? I mean, as you become more and more wealthy, you know, you're probably maybe less interested in some huge upside. You might be more interested in, hey, I want to just make sure I don't lose, right? With a little bit of gain would be great. And so the beautiful thing about real estate is it covers all those bases. You know, if you're buying Apple stock, that's a growth play. You know, it doesn't pay a dividend. There's no tax advantages, right? And it could go up and down. So that's, you know, it doesn't really suit your capital preservation needs either. But if you invest in a good solid mobile home park, for example, it's on real estate, right? So it's not going to zero like my internet stocks did in 2002. It's going to generate income. It's going to grow in value over time. And during that time frame, you're going to get these tax advantages through depreciation and accelerated depreciation. So, you know, the SAFE method, just real quick, is an acronym. Of course, investing isn't safe. I always have to throw out that disclaimer. But if you use the SAFE investing method, you can eliminate some risk. So S stands for sponsor. Who is the dude that you're giving your money to, right? What's their background? What's their track record in this asset class? What does their team look like? You know, just all of those kinds of things, right? A is for asset. What is the asset that you're actually investing in? I love asking like crypto investors, like, what is the asset you're investing in? And can you explain it to your mother? Can you explain it to your young child? You know, I can pretty easily explain self-storage, you know, to my mom, right? So it's important to understand the asset that you're investing in and really understand it, because when you understand it, you understand the market, you understand what's going to impact the value of it up or down, and then that helps you make a decision as to whether it's going to be a good investment. F is for financials. What are the financial aspects here? What are the returns projections? What are the revenue projections? Are they realistic? Has the sponsor delivered those kinds of results in the past? So if, you know, they used to call it a hockey stick, you know, if the revenue projections are like going up like a hockey stick, you know, maybe that's a red flag. Like, you know, it's really, really hard to do that in most businesses. So if the revenue projections are not reasonable, then, you know, it's a red flag. And if at any point you find something that you don't like that's going to keep you from sleeping well at night, you just say no and you go find another opportunity, because I tell you, they are everywhere. And finally, E is for exit. How do you get out of this thing? It's not like you can go to Schwab.com and click and sell your position in a Belrose Storage Group syndication deal. It just doesn't work that way. So as an investor, you need to know that your money is going to be tied up for, you know, 3, 4, 5 years, maybe longer if it's a development deal, maybe shorter if it's a different type of opportunity. But so that's in a nutshell, Brett. That's the SAFE investing methods. As an investor, you want to find those kind of niche opportunities. So like when we found distressed mortgage debt, I was like, you know, when you talk to people about it, if they look at you and, you know, that's crazy, or yeah, you shouldn't be, that's stupid, you know, you're going to lose all your money. Sometimes they might be right, but sometimes they might just be overlooking an opportunity that other people just aren't seeing. And that's what happened with us in the distressed mortgage debt business. Was as we listened, because we did, we as we were kind of building our business and talking to people out there, we talked to some real estate attorneys and some foreclosure attorneys. We were trying to really understand the asset class, and a lot of them were like, you guys are crazy. But then a couple of them were like, hey, you know what, you might be onto something here. And another guy who's he's a capital raiser, you know, fund manager guy, he was like, you guys are going to make a lot of money. So, you know, you got to look for those kind of niche opportunities. That's where I've been able to find the best bang for the investment buck.